revenues and expenses, you consolidate based on timing when it became a subsidiary. That is what we call piecemeal acquisition. Now, remember, when you acquire this company on 1st January or up to 1st April, the examiner will not ask you to do goodwill, because in most cases, we don't do goodwill in the associate. Therefore, examiner will ask you to prepare goodwill from when you gained control. This one is when you are gaining control. From when you gained control, that is when the examiner will want you to do the goodwill. Therefore, how do you do the goodwill? Goodwill. How do you prepare the goodwill? We are going to have two investments. The investment in associate, then the additional investment to make it 60%. We are going to have two investments. The investments that I paid in this part and the investment that I paid when it became a subsidiary. Therefore, here I will take fair value of initial investment. If I want to compute goodwill, I will take fair value of my initial investment, that is in the associate. Then I do the additional investment. I add additional investment. If there is NCI, I come to add fair value NCI. I come to add fair value NCI. Then I come to less identifiable net assets. When I cross from where control was gained, control was acquired. From where control was acquired, then I get goodwill. Therefore, basically what I'm saying is that examiner will want you to prepare goodwill. But this goodwill will be from when you gained what? Control, from when control was acquired or control was gained. Therefore, that is in simple terms how you do fair piecemeal acquisition. Let's look at an example, a small example. Let's look at small example. Small example. Let's look at a small example. You say H Limited acquired 40%. You say H Limited acquired 40% in S Limited. H Limited acquired 40% in S Limited for Kenya shillings 40 million. For Kenya shillings 40 million several years ago. H Limited acquired 40% shares in S Limited for Kenya shillings 40 million several years ago. On 1st January 2024, H Limited acquired on 1st January 2024, H Limited acquired additional 35%. H Limited acquired additional 35% for Kenya shillings 45 million. For Kenya shillings 45 million. For Kenya shillings 45 million. When the fair value of the identifiable net assets when the fair value of identifiable net assets in SC Limited were Kenya shillings 1 or 5. When the fair value of identifiable net assets in SC Limited were Kenya shillings 1 or 5 million. Were Kenya shillings 1 or 5 million. The fair value of NCI at the fair value of NCI on 1st January 2024, the fair value of NCI on 1st January 2024 was Kenya shillings 32 million. Was Kenya shillings 32 million. Was Kenya shillings 32 million. And the fair value of the original investment and the fair value of the original investment in 40%, the fair value of the original investment in 40% were Kenya shillings 52 million. Were Kenya shillings 52 million. The fair value of the original investment in 40% were Kenya shillings 52 million. Required, prepare goodwill. Required, prepare goodwill. Required, prepare goodwill. Prepare goodwill. Therefore, examiner wants us to prepare goodwill in a step acquisition. Remember, first we acquired 40%. We acquired 40%. Then we added additional of 45%. Therefore, it became the subsidiary of 75%. Therefore, examiner will want us to compute goodwill. Therefore, goodwill, let's compute the goodwill in this case. Goodwill. I will take fair value of original investment, which is 52 million. Which is 52 million. I will take fair value of the original investment, which is 52 million. Remember, we invested 40 million in 40%. It was 40 million in 40%. But at the point we gained control, examiner is saying, what was the fair value? The fair value of the original investment was now 52 million. Was now 52 million. Therefore, what we do is we take the fair value of 52, then we add additional investment in 35%, which was 45. We come to add additional investment in 35%. Then we add fair value of NCI, which was 32. Fair value of NCI. We add fair value of NCI, 52 plus. We get 129. Not quitting, you say, will be the question. We say H Limited acquired 40% shares in S Limited for Kenya shillings 40 million. For Kenya shillings 40 million. For Kenya shillings 40 million several years ago. On 1st January 2024, H Limited acquired additional 35% for Kenya shillings 45 million. For Kenya shillings 45 million, when the fair value of the identifiable net assets, were Kenya shillings 105. The fair value of NCI on 1st January 2024 was Kenya shillings 32 million. And the fair value of the original investment The fair value of the original investment in 40% were Kenya shillings 52 million. Required, compute goodwill. Therefore, we are saying we take the fair value of original investment, you add additional investment in 35%, which was 45. Then we add fair value of NCI. We come to less identifiable net assets. Identifiable net assets of 1 or 5. Therefore, I get goodwill. I get goodwill of 24. Goodwill of 24. Therefore, that is when examiner will want you to do goodwill. At the point when you cross the accounting line, you do goodwill. Therefore, our goodwill is 24. Our goodwill is 24. Now, let's come back to our schedule again, to our structure here. Let's come back to our structure. Now, at the time we cross the accounting line, that is when we start accounting for it as a subsidiary. That is when you start to account for this company as a subsidiary. But now, going forward, any additional investment, will not change the accounting treatment, because once it's a subsidiary, it will be accounted for as a subsidiary. Anything going forward, it will only affect what we call NCI. It will only affect what we call NCI. Now, remember, this is what Marimu is saying. For example, let me have this structure here. 1st January, that 1st December. Now, here I acquired, in our case, we acquired 40%. 40%, then we added 35%, it came to 75%. 75%. It came to 75%. Then we are recognizing this one from when we cross the accounting line. From when we cross the accounting line. Therefore, going forward, even if I add, like for example, I add 10%, it comes to 85%. It will not change the accounting treatment, because once the subsidiary, you consolidate. The only thing that will change here is the NCI. The only thing that will change here is the NCI, because when we had 75%, NCI was 25%. When we increased to 85%, NCI came to 15%. Therefore, going forward, when you buy more shares, you only buy from NCI. You only reduce the NCI. You only reduce the NCI. Therefore, at this point in time, examiner also may want to ask you to compute the fair value of NCI, the change in NCI. In this case, when you are acquiring more, it is a subsidiary, and you acquire more shares, it means you are increasing your share as you reduce the NCI. Therefore, examiner may want you to compute how to compute the fair value of NCI. Therefore, you put another dash and say, after we have the goodwill, we have to continue with that question, with that same question. Therefore, you say, using the previous example, we want to use the same question. Therefore, you say, using the previous example, H Limited acquired, using the previous example, H Limited acquired, using the previous example, on that 1st December 2024, using the previous example, on that 1st December 2024, H Limited acquired a further 5%, of S Limited, for Kenya shillings 8 million. For Kenya shillings 8 million. For Kenya shillings 8 million. S Limited had made profits. S Limited had made profits. S Limited had made profits since H Limited acquired control. S Limited had made profits since H Limited acquired control of 10 million. S Limited made profits since H Limited acquired control of 10 million, 10 million, of 10 million. There has been no impairment of goodwill. 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 Required, 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 required. Prepare journal entries. Prepare journal entries. Prepare journal entries to record the change in ownership. Prepare journal entries to record the change in ownership from 75% to 80% required. Prepare journal entries to record the change in ownership from 75% to 80%. Prepare journal entries to record the change in ownership from 75% to 80%. Therefore, remember, we are using the previous example where we acquired in steps. Again, we are continuing in steps. But when we continue in steps, the only thing that will be affected is the NCI, because when it's a subsidiary, even if you buy 100%, you are still going to consolidate 100%. Therefore, the only thing that is going to change is the ownership in NCI. Therefore, let's see how it is going to change ownership there. How it is going to do it to change the ownership. Now, remember, we acquired this subsidiary. It was 75%. We added 5%, therefore it came to 80%. It came to 80%. It came to 80%. Therefore, at 75%, NCI was 25%. At 80%, NCI is 20%. Therefore, as you can see, NCI is reducing as our share is increasing. Therefore, NCI at 25% was NCI at 25% was 32. It was 32. When we gained control, it was 32. Then we come to add post-acquisition NCI share. NCI share of post-acquisition profit. NCI share of post-acquisition profit, which is 10 times 25%, because we said since we gained control, the profit was 10 million. Therefore, it's coming to 2.5. When you add, you get 34.5. Therefore, NCI at 25% is 34.5. That is NCI at 25%. Then we come now to reduce 5%. We come to less 5% of 25%. Remember, it was 25. Out of 25, we are selling, out of 25, we are selling 5% of 25 times 34.5. How much are we selling there? How much are we selling there? It will be 5 over 25 times 34.5. We are selling 6 6.9. Therefore, NCI 25, we are reducing it by 6.9. Therefore, my NCI at 20, NCI at 20% will be 27.6. 27.6, that is the NCI at the end. Therefore, this NCI is what the NCI I'm going to take to the balance sheet. That is the NCI I'm going to take to the balance sheet. NCI I'm going to take to the balance sheet because we reduced it. It was to be 34, but we sold 5% of our 25. Therefore, it comes to 27.5. Therefore, that is when you increase your shareholding, the NCI will reduce. Therefore, when you increase more shareholding to be more subsidiary, the examiner will want you to keep the value of NCI. This is how you do it to get the fair value of NCI. You reduce the NCI by the ratio you are purchasing. But remember, examiner wanted journal entries. Examiner wanted journal entries. Therefore, how are we going to give journal entries? How are we going to give journal entries? We are going to debit NCI by 6.9 because we are selling NCI. Therefore, we debit NCI by 6.9. That is what we are purchasing. Then I credit cash. I invested 8 million. I credit cash. I credit cash because I invested 8 million. When you read in our question, we invested 8 million to buy 5%. Therefore, we acquired 6.9 at 8 million. But it has not balanced. The difference is 1.1. It means I'm also going to debit OCI or other components of equity with 1.1. Therefore, I'm also, because I overpaid to acquire NCI, it will reduce my components of equity. My OCI, other components of equity, will reduce by 1.1. Therefore, when I go to the balance sheet, let me prepare the balance sheet. I want to show you how to prepare the balance sheet. Balance sheet under ordinary share, under capital and reserves. Under capital and reserves. Here I will take ordinary share capital. Of course, we take parent only and retain earnings. Of course, I will have retained earnings. Then I come to non-controlling interest NCI. I will take 27.6. Then OCI, other components of equity, 1.1. But I less because we are going to reduce our reserves. I reduce. That is how you report in the balance sheet. Because we are reducing our reserves, you less. That's why Malim is putting it in bracket there. We less from other components of equity. That is all about piecemeal acquisition. There. That is all about piecemeal acquisition. We can do one question. That is April 2023. Let me see. We can do one question. Yes, April 2023. We can do one question, and the question is April 2023. The question is April 2023. We can do one question. April 2023. Question number 1. Question number 2. Question number 2. April 2023, question number 2. April 2023, question number 2. It says, the following are the summarized financial statement of P Limited and S Limited for the year ended at 1st December 2022. We have P Limited and S Limited. We have property, plant, and sorry. See this question? Yes, it is the question. Property, plant, and equipment. We have investment in S at cost, current assets, equity and liabilities, share capital of 1 per value, revenue reserve, current liabilities. The statement of profit and loss and other comprehensive income for the year ended at 1st December 2022. We have revenue, cost of sales plus and expenses, profit before tax, income tax expense, profit for the year, other comprehensive incomes, items that will not be reclassified to profit or loss, gain on property revaluation, net of tax, then total comprehensive income. We go to additional information. P Limited acquired 25% of S Limited on 1st January 2021 for Kenya shillings 24,000 and exercised significant influence over the financial and operating policy decision of S Limited. Number 2, the fair value of S Limited's identified component assets and liabilities as 1st January 2021 was equivalent to their book value. S Limited's reserves stood at 6960. A further 35% stake was acquired by P Limited in S Limited on 30th September 2022 for Kenya shillings 5040. The fair value of S Limited's identified component assets and liabilities as at that date was Kenya shillings 11,040 and S Limited's revenue reserve stood at 9,360,000 as at 30th September 2022. S Limited share price was shillings 14.5. Share price was shillings 14.5. Number 4, the difference between the fair value of the identified component assets, the assets and liabilities of S Limited and their book value was due to brands. The brands were estimated to have an average remaining useful life of 5 years from 30th September 2022. Number 5, incomes and expenses are assumed to accrue evenly over the year. Neither company paid dividends during the year and neither issued any shares. Number 6, P Limited elected to measure non-controlling interest as at the date of acquisition at fair value. Number 7, there is no impairment loss on goodwill as at that 1st December 2022, while amortization of brands is classified as a cost of sales. Required a consolidated statement of profit and loss and balance sheet. Therefore, we said yesterday that in any group question, you start with the structure. You start with the structure. And in our structure, P Limited acquired S Limited. We acquired this company. The examiner says P Limited acquired 25% on 1st January 2021. 1st Jan 2021. When are we preparing the financial statement? that first December, that first deck 2022, that first December 2022, that first December 2022. Then we had this company for 2 years. We had this company for 2 years. But remember, first we acquired 25%. And let me give this structure. On 1st January 2021, we acquired 25%. Therefore, it was an associate. Then we added additional shareholding. Note number 3, a further 35% stake were acquired by P Limited in S Limited on 30th September 2022. On 30th September 2022, we acquired a further 35%. Therefore, it became 60% subsidiary. Therefore, it means that it was a subsidiary during the year for how many months? Because we are consolidating on 30. We are consolidating the books as at 31st Dec 2022. Therefore, it was a subsidiary for how long? We are counting from 1st of October, November, December. It was a subsidiary for 3 months during the year. It was a subsidiary for 3 months. Our year of consolidation, it is coming to be a subsidiary of 3 months. Therefore, if it's a subsidiary of 3 months, it means in the income statement, everything will be apportioned for 3 months. Everything will be apportioned for 3 months. That is the structure. That is the structure. That is the structure. Therefore, we added 35%. Therefore, it came to 60%, subsidiary of 60%. But it was a subsidiary for 3 months. 3 months during the year. Remember, we acquired in 2021, but on 30th September 2022, that's when everything changed. Therefore, we are going to recognize it as a subsidiary from 30th September 2022. And remember, the examiner says we are consolidating on that 1st December 2022. Therefore, the next thing, I'm going to compute goodwill. The next step, I'm going to compute goodwill. We come to compute goodwill. We come to compute goodwill. Then goodwill, we are going to take fair value of original investment. Then we become additional investment in 35%, which was 50, 40. Then we can add fair value of NCI. We add fair value of NCI. Fair value of NCI. We add fair value of NCI. Then whatever we get as total, we come to less identifiable net assets, of which the examiner says it was 11,040. Examiner says it was 11,040. Identifiable net assets, you get it from note number 3, 11,040. Therefore, who can give us the fair value of original investment? The fair value of original investment. The fair value of original investment. Who can give us? Who is a good student to help Mahim there? It's good to respond to these things. The fair value of original investment. Who can give Mahim? the fair value of the original investment. Now remember, at acquisition, when control was acquired, when control was acquired, the examiner has given us the market price of shares in S Limited. In S Limited, at the time control was acquired, the examiner has given us the fair value of the market price of the shares in S. You can read in note number 3. A further 35% stake was acquired by P Limited in S Limited on 30th September 2022 for Kenya shillings 5040. 5040 is the additional investment. 5040 is the additional investment. And Ruth, you are saying 7464. 7464, remember original investment. Original investment was 2424. Then additional investment was 5040. Therefore, that is where we are getting the cost of 7464. That is not the fair value of the original investment, because that is plus the additional investment. Therefore, that one is not the fair value, but it is good. It is good that you responded, because Marimu feels happy when you respond like that. Marimu feels happy, because if you ask something, people don't respond, then you think otherwise. But now I'm very happy because you responded that it's 7464. That is why Marimu is also taking the initiative to show you how 7464 is coming. It is the original investment in associate was 2424. Then additional investment in 35 was 5040. Therefore, total comes to 7464. But now I want to give you the fair value of the original investment, this one. I want to give you the fair value. Now, the fair value, because the examiner has given us the market price of the shares in S, now to get the fair value of associate, it will be, I'm going to take the shares in S, which is 960 times 25% times 14.5 times 14.5 times 14.5, it will be 960 that 3480. That 480 is the fair value of the investment in associate. Because once the examiner has given you the market price of the shares in S, then it means NCI, you use that market price. NCI, you use that market price. Also associate, you use that market price. Now let me show you the fair value of NCI. Fair value of NCI. Let me show you the fair value. Now that we acquired 25% plus 35%, which is 60%, NCI equals to 40%. Therefore, I will take 40% times 960 times 14.5. Remember, I told you yesterday, and I said I will be repeating. If you get it, well and good. If you don't get it, well and good, because it's your wish that you don't get it. I told you yesterday that once the examiner has given you the fair value of the market price in S, once the examiner has given you the fair value of the market price of the shares, then to get the NCI, you just take the shares of NCI times that market price. Like in this case, when you check in the subsidiary, the shares are 960 at shillings 1 each, times 40%, which is the NCI, times that market price. How much do I get? That is 0.4 times 960 times 5568. That is the fair value of NCI at acquisition. Fair value of NCI at acquisition. Fair value of NCI at acquisition. Therefore, I have the fair value of original investment in associate, which is 3480. 3480. Then NCI using the market price 5568. Therefore, how much is my total investment? How much is my total investment? It will be 3480 plus 5040 plus 5568. I'm getting 14088 minus 11040 3048. 3048 is my goodwill. If I'm not wrong, 3048 is my goodwill. 3048 is my goodwill. Any question up to that point? Any question up to that point, Ruth? Any question? Any question? You say you are okay, thank you very much. Now, that is the goodwill, 3048. Goodwill is 3048. Now, because we did recognize associate, we need to check if there is any gain or loss on the recognition. Let's see if there is any gain or loss on the recognition of associate. If there is any gain or loss, before we do the income statement, let's see if there is any gain or loss on the recognition of associates. We want to see if there is any gain or loss on the recognition of associates. Here, you take the fair value at the end, at the recognition. Fair value at the recognition, which is 3480. Then I come to less cost of investment. Cost of investment was 24. Cost of investment was 24. Then I add, out of that, I add post-acquisition profit. In that associate. Post-acquisition profit, the parent is 60%, therefore NCI is to be 40%. Yes, definitely that is the correct one. If the parent, it was 25 plus 35, it comes to 60. NCI definitely is 40 because we need to have 100% in any company. Now let's look at fair value at the recognition. Gain or loss on the recognition of associates. What is the fair value? Is that for what? 80. Then how much do we invest? We invested 24. What is the post-acquisition profit? Post-acquisition profit is when we acquired, the profit was 69.60 at acquisition. When we acquired control, when we gained control, examiner says the profit is 93.60. Therefore, when you find the difference times 25%, we get the post-acquisition profit when it was associate. I will take 93.60 minus 69.60. I'm getting 24 times 25%. I'm getting, let me repeat, 9360 minus 69, 60, 24 times 0.25, 600. 600. Post-action profit is 600. Therefore, my associate, listen very carefully here. My associate was supposed to be 3024. My associate was supposed to be 3024, but examiner gave me the fair value. How do we get associate? Let me ask you a question, Ruth. How do we usually get associate? Ruth, how do we usually get associate? We get associate by getting the cost of investment, which was 2424, plus post-acquisition profit. Post-acquisition profit, examiner told us that when we acquired this subsidiary, the profit was 6960. But when we gained control, that is when we changed it to a subsidiary, the profit was 9360. Therefore, the difference, it is the post-acquisition profit in the associate. Then we take our share, which comes to 600. When we add the cost of investment, we need to have 3024. But the examiner is telling us the fair value is 34.80. The fair value is 34.80. Therefore, I take 34.80 minus 3024. 456. 456. That is the gain on the recognition. Gain on the recognition. Gain on the recognition. Gain on the recognition. Therefore, the parent company gained something there because of the fair value. And when we evaluate our associate, it needs to be 3024 at the time of the recognition. But the examiner is giving us the fair value of 3480. Therefore, there is the recognition there. There is gain on the recognition of 456 there. Therefore, that is what we are supposed to do in that question. Then also we need to check fair value adjustment. Fair value adjustment on net assets. On net assets. Remember, examiner told us that there was fair value adjustment. There was fair value adjustment. When you read note number 4, let's read note number 4 together. Let's read note number 4 together. It says, the difference between the fair value of the identifiable net assets and liabilities of S Limited and their book value was due to the brands. The brands were estimated to have an average remaining useful life of 5 years from 30th September 2022. Therefore, there we need also to recognize fair value adjustment. Therefore, identifiable net assets. Identifiable net assets equals to 11,040. Those were the identifiable net assets when we gained control. Then we come to check on the carrying amount. We come to check the carrying amount. Carrying amount when we gained control. Carrying amount of this subsidiary when we gained control, we take ordinary share capital. Ordinary share capital. Carrying amount when we gained control, ordinary share capital is 960. 960 is our ordinary share capital. Then profit when we gain control, is 9360. The profit, which is pre-acquisition profit, was 9360. Therefore, I take 960 plus 9360. I'm getting 10,320. This is the carrying amount, but the examiner gave me the fair value as 1140. Therefore, the difference is fair value adjustment. $720. Therefore, our fair value adjustment is $720. Fair value adjustment is $720. Fair value adjustment is $720. I believe you are getting something there. Examiner told us that the identified project assets were 1140. But when we check the carrying amount at the time the control was acquired, ordinary share is this. Profit, that is pre-acquisition profit. Remember, we are taking not profit in the balance sheet, pre-acquisition. What was pre-acquisition when we are gained control? At the time we gained control, it was 9360. We add our net assets for goodwill was supposed to be 10,320. But the examiner gave us 11,040. Therefore, the difference is what we call fair value adjustment. The difference is what we call fair value adjustment. Fair value adjustment. Now, that fair value adjustment, we report amortization. Amortization equals to 720 divided by the useful life. Divided by the useful life, examiner said that it has the useful life of 5 years. We divide by 5. We divide by 5. We divide by 5. Amortization each year, it will be 720 divided by 5. We get 144. 144 times 3 over 12, because it was a subsidiary for 3 months. Subsidiary for 3 months, therefore times 3 over, I'm getting amortization of 36. Amortization of 36. Examiner says that that is a cost of sale. We add the cost of sales. We add that amortization to the cost of sales. We add it to the cost of sales. We add it to the cost of sales. Now, before we do the income statement, let's have a break of 5 minutes. A break of 5 minutes. When we come back, we look at the income statement and the balance sheet. Then we are done. We look at the income statement and the balance sheet, because we already have fair value adjustment, amortization, goodwill, gain on recognition. Therefore, the only thing that is remaining, the income statement. Therefore, let's have 5 minutes for the income for break. Okay, let's proceed. Now we do the income statement, the profit or loss statement of this question, profit or loss statement. Profit or loss statement. We say B group, statement, consolidated, we say B group, consolidated, statement of financial position as at that past, consolidated profit or loss. It's not financial statement, profit or loss. It is profit or loss. We start with profit consolidated. Profit statement of profit and loss for year and 31st December 2022. That 1st December 2022, we underline, we put our currency shillings in millions. We put our currency Then we go to our profit or loss statement. Profit or loss statement, we have revenue. We have revenue, which is 12,240, plus the one for the subsidiary, 4,800, times 3/12. Remember, we are consolidating this subsidiary for only 3 months. Therefore, you take 3/12. Then we go to the cost of sales. 10,800 plus 4,320 times 3/12, but plus 36. 36 is amortization. Amortization, 36 is amortization. Amortization, that is 36, amortization. Then you give me the gross profit. You give me the gross profit. Then we come to less. We don't have any other expense, then we less taxation. Less taxation. Less income tax, that is tax expense. 432 plus 96 times 3/12. You come to less taxation there after profit, after tax. Then I come to add gain on the recognition. Gain on the recognition of associate of 456. That one we computed already. Gain on the recognition. Gain on the recognition. Then I come to add profits, group share. Of profit after tax in associate, group share of profit after tax in associate. That is 384 times 9/12 times 25%. Where am I getting that? Let me explain. Group share. Kindly let Malim explain this, give him time. When you check in the balance, in the income statement, profit for the year in the subsidiary is 384. And remember, this company was associate for 9 months during the year because it was a subsidiary 3 months. Associate was 9 months. It was associate of 25%. Therefore, we get the group share of profit after tax. Group share of profit after tax. That is 384 times 9/12 times 0.25. I'm getting 72. Therefore, I add there 72. Then I get profit after tax. I get profit after tax. After I get that profit after tax, I less profit attributable to NCI. To NCI, I come to less profit attributable to NCI. I come to less profit attributable to NCI. Profit attributable to NCI. How am I going to get profit attributable to NCI? How am I going to get profit attributable to NCI? Remember, profit for the year. NCI profit equals to, you take profit after tax, NCI share, NCI percentage, times profit after tax in the subsidiary. In the subsidiary, I will get profit after tax times profit after tax in the subsidiary. Then I come to get adjusted profit after tax in the subsidiary. Adjusted profit after tax in the subsidiary. We did this yesterday, and I told you we shall be repeating it several times. When you check in the yesterday's question, we did this item very well, and I promised that we shall be doing it. Then we are going to do it again. Profit after tax. Profit after tax is 384 times 3/12. It was a subsidiary for 3 months. It was a subsidiary for 3 months, therefore 384 times 3/12 equals to 96. Then I come to less UPS upstream. Yesterday I explained this. I will not explain again. Yesterday I explained depreciation. We come to less depreciation under charge. Yesterday I explained. I will not repeat to explain. We come to less amortization if it is there. Amortization, yes, in this question we have amortization of 36, fair value adjustment. We come to less impairment loss, fair value method. If fair value method was used, this one we do not have impairment loss. Then we come to add depreciation overcharge. We add depreciation overcharge. Therefore, I'm getting 60 adjusted profit. After tax is 60. Now, after I get 60, I take 60 times 40%. I get 24. I less 24 there. Then I get profit attributable to parent shareholder. That becomes the end of my income statement. That becomes the end of my income statement. That becomes the end of my income statement. For what examiner wanted you to give you 10 marks, that is what examiner wanted to give you 10 marks. That is what examiner wanted to give you 10 marks. Any questions so far? Ruth, any question? Any question? Let me give you time to write that. Let me give you time to write. And make sure that you give me those figures. You don't put XX. If you put XX, it will mess you up when you will be revising. Make sure that you are putting their figures. Make sure that you are putting their figures. If you are done, you say yes, Wasiri. If you are done. because I will not wait forever. If you are done, you say yes. Thank you. You are done. Now let's do the balance sheet. 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 We say P group, consolidated statement of financial position as at 31st Dec 2022. Billings in millions as at that 1st December 2022. We do the balance sheet. We start with non-current assets. Non-current assets. We start with non-current assets. Under non-current assets, we have PPE, property, plant, and equipment, where we have 46,380 plus the one for the subsidiary 9120. That one you take full, you don't apportion. You don't apportion. Then you write goodwill. We did goodwill, if I remember very well, it was 3048. If I remember very well, my goodwill, if I remember very well, it was 3048. Then we have grants, which was fair value adjustment, 720. That one we already did, minus 36. Amortization. Amortization minus amortization of 36. Then you give me total. Then we go to current assets. Current asset, examiner just gave us one current asset, which is 15 to 40 plus 2640. Give me total. There was no UPS, therefore nothing to less. There was no intercompany owings, therefore nothing to less. Then you give me total assets. Total assets. After that, you come to give me capital and reserves. Ordinary share capital, parent only. Ordinary share capital, parent only, which is 12 to 40. to 40, parent only. Retained earnings. Retained earnings. That one we have not done it. Non-controlling interest. Non-controlling interest, we have not done it. Therefore, I put a dash. I have not done non-controlling interest there. I put a dash. And also in an exam, make sure that these items come last because they take a lot of time. But this one is just addition. These two items takes your time. Therefore, even in an exam, do them as the last resort after you have done everything. We have current liabilities. Current liabilities, 8940 plus 1320. Then you give me total equity and liabilities. Total equity and liabilities. You give me total equity and liabilities. Total equity and liabilities. Total equity and liabilities. Now, let's work out for NCI and the retained earnings so that we complete the question. Let's work out for the retained earnings and NCI and NCI. We begin with NCI. We begin with NCI. Let's begin with NCI. NCI. Fair value of NCI. We take fair value at acquisition, which was 55, if I remember very well, 5568. Was it 5568? Let Marino try. It was 0.4 times 960 times 14.5. Yes, 5568. Then we come and add NCI share of post acquisition profit. Post acquisition profit, we come to add NCI share of post acquisition profit. Post acquisition profit. Post acquisition profit. NCI share of post-acquisition profit. NCI share of post-acquisition profit. Out of this, I'm taking the profit in the balance sheet, 94.80 minus 93.60. I get post-acquisition profit. I get 120. Then I less 36 in amortization. I less 36 amortization. I get 84 times 40% times 40%. I get 33.6. 33.6. 33. Why? Total profit in the balance sheet is, listen here, total profit in the balance sheet is 94.80. When we gained control, that is when it became a subsidiary, the profit was 93.60. Therefore, it means that post-acquisition is 120. But out of that post-acquisition, there is amortization of that 6. Therefore, you less the amortization, you get 84. Out of this 84, we have 40% of the parent. 40% of the NCI, the parent is 60% of that 84. When we go to the parent, we take 60%, but to the NCI, we take 40%. You only take 40%. You only take 40%. You only take 40%. I hope you have got it. I hope you got it. I hope you got it. Therefore, my NCI at the end, I have 5601.6. That is my NCI at the end. I come to report NCI 5601.6. You just take NCI at acquisition plus the post-acquisition profit. Post-acquisition profit, why am I taking this? When we acquired the subsidiary, profit was 9360 when it became a subsidiary. At the balance sheet date, it is 94. Therefore, post-acquisition is 120. We subtract the impairment and the amortization, we get 84. This 84, NCI 40%, parent 60%. Parent 60% there. Then we come to retained earnings consolidated. Retained earnings. Consolidated retained earnings. This is why I said you do them as last items, because sometimes they can take your time. You always do them as your last items. Consolidated retained earnings, you take 100% profit of the parent, 100% profit of the parent, of which is how much? Of which it is how much? 100% profit of the parent, 47,904. 47,904 from the balance sheet. Then I come to add group share of post-acquisition profit in the subsidiary. I come to add group share of post-acquisition profit in the subsidiary. Group share of post-acquisition profit in the subsidiary, of which it is 60% times 84. Already we did the 84, it is there. 60% times 84. 50.4. 50.4. Then I also come to add group share of profit after tax from associates. Where you take 9/12 times 384 times 25%. We already did that when we were doing associate. We already did that. Or let's just take, instead of doing it in steps, let's just do it once. Let's just take it as post-acquisition, a group share of post-acquisition profit in associates. Instead of doing it in pieces, let's just do it once. I will take 9360 minus 6960, the whole thing times 25% times 25% times 25% times 25% times 25% times 25% there times 25%. I get how much? Let me see. 9360 minus 6960 times 0.25, 600. 600. That is when it was associated. Why am I taking 9360? Why am I taking 6960? Remember, when we acquired this company on 1st January, profit was 6960 when you read note number 1. But the time we gained control, we removed it from associate to a subsidiary. Their profit was 9360. Therefore, in between, how much was their profit? Then we take 25%. 25%. Then also we come and add gain on the recognition. The recognition. Gain on the recognition, it was 456. Gain on the recognition of this associate. When we recognize associate, there was some gain that we got. Gain on the recognition, that one we did it very well. I believe you understood the gain on the recognition. Therefore, nothing else. You give me total retained earnings. I'm getting 49,010.4. Therefore, I come to put here in my balance sheet 49,010.4. Then we are done with our question. We are done with our question. Always I'm advocating that retained earnings always do it the last item, because these others, you just add this plus this, this plus this. But when you come to retained earnings, remember it needs work. Sometimes you can waste a lot of time on it, and it also, you also get a wrong answer there. Therefore, you waste a lot of time, which is not a good thing. Always begin with free marks. Like here, ordinary share capital parent only. That's always a free mark. Current liabilities H plus S, free mark. Current assets H plus S, free mark. PPE H plus S, free mark. But when you come to retained earnings, you need some sort of workings. And you might forget one thing, and it comes to be wrong. Like, for example, you can forget gain on recognition or profit from associate, then it becomes wrong. Therefore, you have wasted a lot of time doing it. At the end, it's also something wrong. Therefore, you need to work smart. You need to work smart. That is what we call piecemeal acquisition, where you acquire a company in steps. The most important thing I want you to know is that you only account for the subsidiary in the income statement from the point you gain control. But in the balance sheet, once it's a subsidiary, you just consolidate. You don't do anything else. You just consolidate. You don't do anything else. In the balance sheet, you just consolidate. Therefore, any question on piecemeal acquisition? Any question on piecemeal or step acquisition? Any question on piecemeal or step acquisition? Any question on piecemeal or step acquisition? If there's no question, then that marks the end of our lesson today. And inakuja kwa mitihani, waziri unauliza inakuja kwa mitihani. But what we are doing is the question of August 2023, which means it came in August 2023. It also came in August 2022, I think August 2022. You will do for me August 2022. August 2022. And we also need to do, but not quitting. I was asking any issue, you did not say anything. Therefore, you kept quiet and you suffered from your quietness. That is good to Mwalimu. Therefore, I asked, if Mwalimu is going fast, you tell Mwalimu you are going fast. If Mwalimu is going slowly, you also tell Mwalimu you are going slowly, because I also want your engagement. But if you are not engaging Mwalimu, then I think you are very much okay. then we move on. Therefore, it is not my mistake there. It is yours because you did not talk. It is yours there. Okay, we meet on Monday. We do disposal of shares in a subsidiary. But for you, you start doing serious questions, and you didn't want to inconvenience the rest, but it is because of your comfort. It is your comfort, and it's just inconvenient for your comfort, because if you don't inconvenient, then you will be inconvenienced in an exam. Imagine being convenient in an exam because you do not want to inconvenience others. That will be more suicidal. That is more suicidal than right now, because you better inconvenience people today and you become well in an exam than being at comfort today, then you be inconvenienced with that paper. Therefore, okay, thank you very much. And thank you very much for your time. Let's meet on Monday for disposal of shares in the subsidiary. Thank you. Bye-bye.